I'll declare the inaugural meeting of the Smart Finance Committee open 2 o'clock. First, I'd like to welcome the committee members, Deputy Chair, Councillor Beck, Councillors Gladding, King and Wong, and like welcome staff and guests to this first meeting. I'd do a quick shout out to any of those of Irish descent, either in person or on the live stream. Happy St. Patrick's Day. And without further ado, we'll get started. So I have no apologies for this meeting, so nothing to report there. Do we have any declarations of conflicts of interest? No. No declarations, no conflicts of interest noted, but no public forum. There are no matters lying on the table. So I'd just like to confirm the agenda. The agenda will be confirmed with the following alterations. There's an addition of a further option for reallocation of the proceeds from the sale of 6 Marion Street, Arrowtown. And a request for a different calculation came after the agenda was circulated. We'll deal with that when we get to it. And I'd like to move item 7, the local government funding agency report, to become item 3 and all subsequent items following in numerical order. Just doing that so that when Miles can speak to his Treasury report, he'll still be around to maybe speak to the LGFA report if we have any questions that he might be in a position to answer, if that's okay with you, Miles. So do I need to move the motion?
Yeah, I've got you moving it.
All those in favour? Aye. And opposed? Motion's carried. Okay, so we'll get started with agenda item 1, council controlled trading organisation monitoring, Queenstown East. That looks like Andrew.
We should have Shane here online. So. So it might be a couple of minutes late, but I'm happy to kick off if you want to keep things pacing.
Oh, you can start if you like.
Confirmation, sort of two matters to address: the interim report and the capital plan update. That's right. Maybe I'll start with the capital plan. Can I be comfortable do it in reverse order? Yep. I'll leave it to Shane to Emma's keep. And so it's the second time we've had the opportunity to meet for obviously the capital plan update. See in the paper that's presented, I wasn't planning to read that out and take it as read, but I'll give you some highlights from that report. Probably the key highlight from the report is since the last update, there's an additional $55 million of capital. The primary allocation of that is to non-aeronautical infrastructure development or non-aeronautical property development. And you will see in the paper that the only approved amount of that total value is a $2.3 million development of a wash bay for Europe car. So therefore the construct of that $36 million, it's a place safe identified, indicating or signalling the direction of travel to invest in non-aeronautical property development as part of our diversification strategy. It relates purely at this stage to the Block D bit of land, which is literally directly adjacent to the northern part of the runway. There's no sort of border plans at this stage that have advanced around the block of land to the north of Hawthorne Drive. So it's the block, what we call officially the triangle that sits behind Packet Safe. So this does not relate to that. So apologies, we're talking about it this morning. It sounds a bit like an investment in a prison calling it Block D, but it's tagged as industrial and commercial property. And at this stage, as far as status, we're applying for consent around some underlying infrastructure for that land. The other key movers or changes that are embedded in the 55 million, what I call BMU, which is our baggage makeup unit. So that's an adjustment to scope of that underlying asset. Airport House, which is our office block, it's a change in scope, and the runway overlay, which is a key piece or strategic and large periodic investment in R&M for our most strategic asset. Pleased to also note that since the last update, we've secured funding now. As is noted, we're looking for an initial, or have instigated an initial tranche of 330 million, which was well below what was offered or subscribed for. And within the 4 banks that we're ultimately proposing to go with, or the club, the total facility capacity within the club was $480 million. So we believe that provides adequate headroom and comfort with respect to the capital program that's in front of us today. We continue to run sensitivities in the business up to 20% plus on capital, and believe that a 20% plus sensitivity to capital can be absorbed within the organisational structure.
Question. Just from a previous conversation, you raised some of that from BOC and ICBC.
Correct.
What was the maturity?
7 years.
And was it in Kiwi dollars?
Yes. So looking for roughly a 50-50 split between ICBC,
right.
50 split, combined, and then New Zealand banks for the remaining 50%. And then the New Zealand banks, whilst they all offered a 7-year split, we're using fundamentally because of prices, international banks 7 years and local banks 5 years.
Questions?
Question?
I've got a few, so I don't have to take them with this discussion on individual points. First one's just around Block D and the plans, and obviously there's been approved a washdown facility, 2.3 million or something. Now, I'm just trying to understand that in light of the direction in the SOI, which is before the commercial development occurs of any sort, doesn't sort of specify lower limits or anything, that the airport will come to and talk to us about what's going on, and that's supposed to be with planning. And I've asked that question, exactly what does that wording in that draft SOI mean? Why have things been progressed, and it sounds like consents are being sought in the background, but it hasn't come back to the shareholder?
Oh, my understanding there was a materiality component about the broader piece.
But the resource consent, so if we go aside the $2.3 million on wash facilities for rental cars, wash bay, how then does that direction to come back to us sit alongside the fact that resource consents are being sought?
Oh, so resource consents for underlying infrastructure at the moment.
So can you tell us what is the plan for the rest of Block D?
Oh, so Block D, at the moment, clearly the broader plan, we're going to make it clear there's only one element approved at this stage. So it's not an approved investment of $36 million. Just want to make that clear.
Okay, and what will it be approved? Like, is that when the resource consents be all?
Well, it gets approved on a case by case basis relative to the strength of the business case.
Okay,
and therefore meeting the hurdles.
So when would it come back to councillors?
Well, so and I haven't got the SOI in front of me. I just have to go back and confirm that. So the construct would be that there should be endorsement or alignment relative to the SOI. So if that's not clear, we'll take that away and ensure there's alignment for the board.
Well, I think there's an expectation around the table, certainly from some councillors, that you come back to us with what's going on for these other pieces of commercial development before it occurs. And I've sought clarity because I think it should be before resource consent is sought. Once you know what you're doing at the earliest point, it would be good for it to come back so that we can understand.
Do you mind if I take that away?
Yeah.
I understand your point. I'll just link that back to the commitment through the SOI. My understanding is it's a commitment to the diversification, but I'll take that away.
So just clarify, is there an actual sort of a plan for that Block D yet? Or?
The answer is there's no immediate plan. There's a direction of travel. We haven't targeted customers, if you like, and then allocated funding for that. We are provisioning. I know it sounds a bit cliche, Heath, but there is a view to diversify that we need to invest in non-aeronautical land. So a direction of travel, there should be an expectation over time that there's an investment in that, in our non-aeronautical land assets.
Okay, cool. So, and the new numbers here for the capital program, they'll be reflected in the SOI when it's finalised.
They're invested, they're included now.
Okay.
Yeah. If we're not clear enough, reflecting the feedback,
You've got Shane online.
I will call them again.
So if there's only a direction of travel, what is the $31 million for?
It's positioned for investment in industrial and commercial opportunities that may present themselves on that land. And part of that at this stage, at a finance level and a commercial level, is an acknowledgement of the need to diversify, and also around funding headroom to ensure that on the basis that clear strategies aligned and the commercial case stacks up, then we'll look to allocate capital to that. But there's no capital allocated because there's no deal or there's no I'm conscious Shane's online now as well. So
If there's any more information, that would be great, but if not, I've got a couple more questions, you know what they are. The first one is just around the gateways to this program. So originally when we, I think it was probably at the meeting to endorse it, when we were told we weren't able to approve it. And look, it was a long time ago, but I remember quite distinctly saying, the Companies Act is a requirement there. This is a significant project, therefore it should get shareholder approval, and that was met with some, what provisions of the Companies Act?
yes.
So we never really resolved that. It went back to the Audit Finance and Risk Committee. They talked about gateways. My understanding was that we would understand how the program was broken up into individual self-sustaining sort of chunks, so that if we needed to cut the program, we could, but we would know that we would still be able to pay down loans, we would still get our dividends because these were independent chunks. I was sceptical because to me the whole program is very interlinked in terms of the funding and the pieces that go together, runway, terminal, they all enhance capacity. Without one or the other, you've got a problem. So I just want some explanation as to how we've complied with the Companies Act, because we haven't approved the master plan, we weren't given that opportunity. I want to understand what those chunks of work are that can be stopped and you can still function financially and operationally.
Is it broad? I'm happy to give the context, but I'm not sure that's going to answer your question. So our advice is that this is not a major transaction. Legal advice, it's not a major transaction under the Companies Act, independent legal advice. I'm happy to work with yourselves on that. And that underlyingly is pinned back to the contractual commitment. So the master plan is clearly a strong direction of travel, subject to scope, detailed scoping, concept and detailed plans, acknowledging that there's a procurement process for each of those core components of the master plan that run separately from a contractual perspective.
So what are the core components?
So my understanding, just to clarify, I think what Councillor Glaving's asking here. So a major transaction per the companies at the highest level was like 50%
of gross assets.
Yes. So, and I mean, on the face of it, the total capital spend obviously exceeds that, but obviously understand that's phased and there's a lot of different components, which I think is the question that Nikki's asking.
I want to understand the components, because if you go into your document, we talk about the gateways,
yes,
and the gateways talk about stages of processing for the different
yes,
components, presumably, but
yes,
it never sets out what those chunks are. I've asked many times, and I've never been told these are the pieces that are wrapped up in the first chunk, and these are the pieces that are in the second chunk. Does that chunking exist?
I understand.
Or
the answer is yes, it does.
Could we see that, please?
I'm happy to provide some insight to that.
Maybe
yes,
the high levels of runway, baggage handling.
Yeah, that's right. Runway baggage.
Yeah,
that's right. Landside terminal around the program.
And just some assurance that having done those things, if we didn't need to complete the rest, we would still be meeting financial obligations. So if that can be wrapped up, that would be great.
Happy to provide that level.
I guess just to move on to that, is the schedule of works done in such a way that you can stop one and complete the rest and pick and choose what you want to do, like one is not contingent on the other necessarily.
Correct. And for example, at the moment, and with bearing in mind the commercial model or aeronautical pricing, this is behind that. At the moment, we have consulted fully with the airlines on the airfield program, for example, the parallel taxiway and the runway overlay. They have confirmed / endorsed that investment in isolation, and we're recovering that investment / will recover that investment through aeronautical pricing over the current term. For example, terminal, we haven't started consulting in detail around the commercial impact. We're consulting around scope with the airlines at the moment. There's no recovery mechanism in that at the moment, and therefore that is still subject to full, let's call it commercial business case and scoping. To give you just a couple of micro examples.
And I guess what would be great is ahead of the chunks proceeding, it would be great to come back to us and say, look, this is where we're at. Because that's what I understood when we were sitting on the AFRC, that we would get some insight into, you're underway under one thing, it's working, here are the numbers, we want to proceed with this, and here's what the change will look like under that.
So you'll be coming to see this committee twice a year, so I'd expect that
the next update.
That'll be
that
part
would
of
be
the
great.
discussion that we so.
Yeah, but we'll be more advanced. So discussions around scoping and concept for the terminal, which is a big piece of work. So timing will work well.
Someone else wants to go. I could do another question, but now I'd like to.
I'll have a go. On the similar vein, the scope change that you're making, is that driven by revenue opportunity or operational or compliance?
Compliance and operational.
Okay, but there's a revenue potential opportunity.
Yeah, so these uplifts here are directly pinned to our aeronautical side of our business.
Yeah, okay.
So fits under the regulatory regime, subject to consultation.
Yes.
Which is ongoing right now, which is looking very positive. There's a revenue construct that sits directly in behind that, and therefore the commercial is highly confident that will translate into a commercial and revenue outcome.
All right, thank you.
And last one was just around the conflict in the Middle East that's going on at the moment, which is obviously affecting Air New Zealand pricing routes. I imagine we're one of the favourable routes, so maybe that's not having a direct impact just yet. But how are you going about managing that risk and doing some scenario planning and around understanding what the potential futures are and how that sits in line with your capital program?
Good question.
Do you wish me to? Hi all. Nice to see you. Sorry I couldn't be there in person. I've just been chairing another audit and risk committee that ran a couple of minutes over times as a result of bad chairmanship from myself. But anyway, good to see you all. I just noting on that other discussion, I think, look, the point on 100% consultation is very, very important to us, that you're both as this committee but across the board with council, and we had a quality update with my chair, CEO, acting CEO yesterday, as well as the mayor, and it's our intention to actually upweight our consultation with council through the year to make sure that there's full understanding of progress, particularly as we upweight the capital program. We're kind of sitting at around, or have been traditionally sitting at about 30 million a year investment. This is going up exponentially to circa 90 to 100 per year over the forthcoming years against the master plan. So it's very important that we're all in lockstep over this and preventing any obviously any misunderstandings or lack of communication, and also making sure that we've got full support from council as our main shareholders. So just on that point, on the crisis, I think I lived in the Middle East for 15 years and was also there during shock and awe when Iraq invaded. When the US invaded Iraq, and it's a very uncomfortable situation, and this is worse because there's missiles firing across into Western friendly countries. That is having an impact obviously on fuel all of the crude, most of the 90% of the crude oil that fuels aeroplanes, at least for the New Zealand market and Australian market, 90% of that comes through the Straits of Hormuz. So that is something that obviously the airlines are watching, nothing that we can have direct impact over. There's a comfortable margin of at least 60 to 90 days at the moment, as we understand it. As you know, Air New Zealand have been already, and as you know, they have some other structural issues that they're addressing, but they've already been trimming some capacity as a direct result of this. We're affected by about 3,000 seats over a period of about a month, until mid-May. Which is very, very little impact on our route structure. The net result of that is as we'd imagine, yes, there may be some pricing adjustments, but mainly it will just mean a higher load factor than there already is. Load factors are probably running around 88% to about 91% at the moment, so we could see a spike in load factors. It's unknown on the impact on passenger traffic at this time. I think everybody, all of our best advice, and we've been liaising with all of our customer airlines, Virgin, Qantas Group, which is Jetstar, Qantas, as well as Air New Zealand. So it's a watching brief right now. Obviously, that a lot of prevention with Middle East airlines in and out, with airports shut down and open and shut down, is going to have a major impact on global travel, particularly outbound global travel, I think, from New Zealand and Australia, and potentially some inbound travel, although most of our inbound is reliant on North American market, North Asia, Asia markets. So we expect at this point not too much impact, and possibly some tailwinds there on people holidaying or travelling closer to home in the case of Queenstown, so we could be a net beneficiary of some additional business moving forward. No impact so far on the Trans-Tasman market at all, although we've had some guidance from Jetstar that they may be looking to adjust some schedules over the next few months, but we've had no official advice. Having said that, Jetstar advised us just 2 weeks ago before this started that they were increasing frequency on Auckland Queenstown. So that's positive, and the demand keeps coming for domestic travel, particularly for Queenstown, where New Zealand have a lack of capacity already because of their existing structural problems. So I hope that gives you a bit of an understanding.
Thanks,
of where we're at.
yeah, just interested in making sure that the airport's looking ahead to what might come and being prudent and careful with that expenditure of.
Just on that change, you'd see, or maybe is that going to have an effect on the capital program? Depends on how long it goes, I suppose.
We don't believe so. It does depend, I guess. There's views on Donald Trump's wars. He has this ability to turn on and off wars as he sees fit. This appears to be a bit more serious, so it's a watching brief. But we're already taking small steps. A good example this morning, we're providing emergency fuel for our AES firefighters, for example, who are living away, within kind of an hour of town, because there's some fuel shortages in some country towns right now because of panic buying of farmers and locals and things, and just looking at contingencies ahead in a methodical way to make sure that we can continue to operate, obviously, and operate safely. But certainly on the capital plan, we would see this as a short-term impact, and we don't see any impact on the capital program at this point at all. But we'll continue to monitor, of course.
Yeah, I'm just thinking, beyond the fuel, just supply chain issues, getting materials that you require, delays, which then increase costs. So all of that flow-on stuff that we've experienced ourselves.
Oh yeah, and absolutely. So with our suppliers and contractors, we'll certainly watch that. Our major capital program uplift, the first cab off the rank is the parallel taxiway, $60 million or $63 million project. So that kicks off in June. We'll obviously that'll be the one that we're watching, and Airport House as well, which is a little bit beyond that, but later in the year. So we'll keep a very close eye on all contingencies relating to those programs in this context.
Thanks, Shane. So just keep things moving. I understand your guys' time is very valuable. Not that we don't enjoy your company, of course. I will take the 6-month report as read from you. If anyone's got questions on financials, or pretty straightforward within budget. Any comments? Feel like
One more question. Derivatives, hedging, what's that involve?
Oh, so we operate under a treasury policy, derivatives as far as FX and interest rates.
Yeah.
So if FX, we effectively hedge up to 80%, or excuse me, a minimum of 80%
Yeah.
of all FX forward commitments. So that's driven by treasury policy, and from a interest rate derivative perspective, again, same interest rate hedging policy. At the moment, we're at the low end of that, but as we climb into much more deeper or larger capital program, then we'll look to hedge at a higher level than that. But it's hedged between 25% the underlying interest rate exposure to 75% of this policy.
Interest rates up to 75.
Yes, thanks.
Can I ask one really simple question? Sorry, on page 12 of the report under financial performance, is there a reason why all the other revenue increase, earnings, etc., have a comparison, an increase or decrease? Like, sorry, number 12, and it says operating expenditure total 12.3 million, but it doesn't have like a comparison to the is there a reason why it doesn't do that with the other ones do?
No underlying reason other than reflecting that the primary movers or impacts on the financial performance is revenue at a global or group level.
What's that mean?
It means that from a commentary perspective, focus on the key drivers, and the key drivers to the organisational results is effectively passenger movements flying onto revenue. So there's no.
Why put it then?
What's it?
Why put it?
We'll consider that.
Is there something you'd like to see in the report going forward?
Oh no, I just want. Well, why not just do like a comparison of what it was if everything else is? Because then you can see if you are going up or down.
Comparisons are good.
Yeah.
So if you do skip forward into the income statements, there
Well,
are.
I can't really understand that. So.
There are comparatives.
Comparatives.
We don't call out a comparator in the commentary. We can reflect on that.
It's just for consistency, I guess. But if there are no more questions, just before we do that, I would just like to thank you guys for all your hard work and for the interim dividend that was paid. We appreciate that from council.
We really appreciate that.
Confident there's more to come.
And yeah, with that, Matt, if you're happy to move, we've got a second there.
So I just one question to the motion. Sorry, I could have jumped in there, but just when we recommend it to the full council, there's just a switch around from the governance committee doing the two different pieces of work, the remuneration and board appointments. It'd just be helpful when you put it in the paper. So we're recommending, so I won't add it to the motion or anything, but if we can have some detail around what that process will look like for the full council, because I imagine the panel would have worked on it in a little bit more detail in the background. We want to make sure the full council understands, because I don't understand at this point. We're recommending that they make the decision and do all that work, but what is all that work going to look like exactly? How much control will we have over the process? So that could be in the paper, that would be great.
I mean, I guess there's going to be a report with the recommendation on what those dividend directors' fees might be.
It was more for me around the board appointments and that process, because that's what we're recommending as well, that full council do it. What will that look like? So if we can put some detail around that, that would be helpful.
Yeah, I can explain to you what my understanding of that process will be after this.
Yeah.
Yeah, I was just going to say it's a bit odd not having a panel this time around. It's the full 12 of us again.
I was going to suggest this committee maybe, but
We can work with them.
So I assume it would follow a very similar path to what we would as a panel.
I'd like to think so, yeah, that it's not just brought to us and go, you go, sign it off.
Then we leave it as, we'll go through the process, if
Sounds
it's
good.
clunky, full council. We'll adjust it. So all those in favour?
Oh, who was the second?
Those against? Passed. Thank you very much. Thanks. Okay. Thanks, Andrew. Okay, on to.
Thanks all.
Thank you.
Thanks, Shane.
Fifteen questions.
It's in his element.
Miles, Betty, thank you.
When someone else.
Well, hello all. I'll just introduce Miles O'Connor. So Miles is our Treasury Advisor, comes from Bancorp. So he's going to update us on some borrowing treasury matters that impacts the council's borrowing arrangements. And then overall, this paper is for noting. Take it away.
Thank you, and thank you for the opportunity of presenting to what is the first ever Smart Finance Committee meeting.
Thanks for being here, Miles.
My surname is O'Connor, but I'm not Irish, by the way, so yeah.
We'll still celebrate that, right?
Yeah,
Some of it.
just by way of, well, no, actually, the first thing I'll say, I'm not sure if Nikki and Heath have been here going back a wee way, but my standard sort of introduction was I wrote this report 2 or 3 weeks ago, and things have changed since then, because they do over the, in financial markets quite quickly. The other one I used to ask was, how long have I got? Because there was quite a bit going on at the moment, so I could probably spend the rest of the afternoon here. But I wrote this report, finished it on Friday, the 27th of February.
Right.
On Saturday, New Zealand time, the fighting started. So things have changed quite a bit since then, but I'll update you on that. Now, just by way of introduction, for those of you who don't know what Bancorp does, we're a merchant banker based in Auckland, and Bancorp Treasury is the side of the business I work for. We advise corporate and institutional clients on managing treasury risks. So that is principally funding and interest rates, which is what we do for QLDC. We also do currency risk management, commodity risk management. We do one-off reports, just covering maybe treasury health checks. There's quite a bit of scope for the business. Bancorp was established, I think, in 1987. It's the longest I've been in the job, which has been 20 years here. We have 230 clients around New Zealand who we advise on an ongoing basis. So these are anything from government departments, corporates, institutions, and our biggest sector that we advise on is local government. And we have around 40 local government entities, 35 of them are councils, I think, and 5 holding companies, plus we've just been appointed to the 8th water entity of the new water entities that have been set up. I'm based in Christchurch. The firm's head office is in Auckland. I'm based in Christchurch with another, and I head up the local government side of Bancorp. So that's my primary focus. We've been advising QLDC, I think, since about 2008. So it's been quite a long tenure there. And we've seen the debt levels rise quite a bit. I think when we started out, they were about 180 million or 100 million. So they have gone up since then. So that's Bancorp. The report, as I say, it's a week out of date, but actually in answer to your question, Nikki, before I just asked Catherine when we just had a meeting before, Air New Zealand say they've got 83% of their fuel hedged at the moment. And I understand it's around about $85 a barrel. I've got a chart and another one here, which I think is busy. Well, it's gone from 80 to 200.
Yeah, so they've already got it and they've got it in the system, yeah.
Yeah, 200. Yeah, I've got a chart of it here, which I can share with you, but it shows the chart of Brent crude, West Texas Intermediate crude and jet fuel. So the jet fuel is the one that's gone up the most.
80% until when?
80%. That's what we're not sure. Yeah, they said they've got 83% hedged, but it didn't say what the time frame was. I'm quite interested in that. Yeah. As far as the report goes, well, you all know what's happened with the war. The main things that have happened, well, from your perspective, is that interest rates have gone up. And those numbers that you'll see on, I'm not sure what numbered page yours is, but it's where we have the economic commentary is at 27 February, and it's the table of interest rates. Well, that 2-year rate is now 3.37. The 3-year rate is now 3.65. The 5-year rate is now 3.95. The 7-year rate is 4.14. The 10-year rate is 4.35. So you can see that they've gone up very, very sharply. Normally, in times of geopolitical and economic or geopolitical uncertainty, the doctrine used to be that interest rates would go down and equity markets would go down as well. So when interest rates go down or a bond goes down, it actually increases in value. Whereas it's the opposite to the equity markets. When it goes up, it increases in value, obviously. I won't go into the maths behind it, but the theory is, so those holding bonds, and maybe in your Kiwi saver portfolio, you get the advantage of lower interest rates, and that records a profit, whereas the equities go the other way. But this time, equities haven't actually been too bad. They have gone down, but interest rates have gone up sharply. So, what was the standard doctrine hasn't applied so far, because what investors do is they seek the safety of the bond market, and because bonds are seen as more stable and less risky than equities. So investors switch out of equities into bonds. But this time, bond rates have gone up, so they've declined in value. Now, one of our guys in our Auckland office is saying that it's possibly because the initial reaction this time is up as a result of the crisis, and that's the inflationary effects of it. So with the increase in oil prices, because inflation has to be met with an increase in interest rates. But then the secondary reaction is down with the bond, could well be down with the bond rates because of the economic slowdown that is associated with the war, and therefore the need to lower interest rates. I know that sounds a bit contradictory, but most things these days are contradictory. What used to be the doctrine isn't anymore. As far as New Zealand goes, I've outlined how interest rates have gone up, but just going back to last November, we had the last cut in the official cash rate down to 2.25%. Now, this sounds a little bit of a paradox here, but while the OC at the official cash rate and the 90-day rate have gone down, those swap rates that I just talked about have gone up sharply. And that's because the OCR is totally dictated by the Reserve Bank. And then the 90-day rate is very closely correlated to the OCR. But the swap rates are totally dictated by the market. So the markets won, back in November, they preempted the end of the easing cycle because the Reserve Bank cut the cash rate by 25 points, but they said that is basically it, or gave a very strong indication that that was the end of the cutting cycle. So markets said, well, okay, we'll push interest rates up. What they're effectively doing is they're front running the interest rate hikes that will come, just like they did when interest rates went down. They front ran the cuts in the interest rates. So that's why we get asked sometimes what interest rates doing, and sometimes they're going up, sometimes they're going down, sometimes one lot are going down, which short-term rates have gone. I've got another graph in this presentation, and other ones are going up. So you've had short-term rates down, medium, long-term rates up. As far as the longer-term economic impacts of it, well, inflation at the Treasury, inflation at the moment is at 3.1%. The Reserve Bank are forecasting the full 2%. Treasury updated their forecast for inflation and now got that up 3.6%, and for economic growth to slow as a result of the increased fuel prices, because fuel prices obviously flow through to a very significant part of the economy, everything from supermarkets to what you buy from Bunnings and placemakers, everything else. what we have to find out now is what Reserve Bank's view of this increase in inflation is. Ordinarily, it would be met with an increase in interest rates, but will they look through it and say, well, this is a one-off effect as a result of the war, and we can't raise, and we don't want to raise interest rates when the economy is slowing down as a result of the war now. So it's which one do you look at? Now, the one thing I will say though is up until now, the Reserve Bank have said, and this is the new governor, said we are laser, these are her words, laser focused on inflation. So if they're true to that word, then they will increase interest rates faster than what they previously expected. In their latest projections, which was in November, which was in February, they only expected the OCR to go to 3% by 2028, and it's already at 2.25. It's at 2.25% at the moment. It's a very, very shallow increase in interest rates over an extended period of time. The other one I was mentioning just before was the Nikki and Paddy, was that the average time that the OCR stays at its level after an easing, which we've had, is 18 months. So if that was the case, that wouldn't be rising till May 27, yeah, because it was November 2025, so that'd be May 2027. I don't think that'll hold true now. So what we're really waiting to see is how the Reserve Bank react to this increase in inflation and the possible economic slowdown. So I can't be any more definitive than that. I mean, I wish I could be, but we just don't know what their attitude is going to be.
But you're talking to Catherine regularly.
So what's that?
You're talking regularly. Yeah.
Yeah. Oh, yes.
Thanks.
As far as the report goes, I think you probably read it all. I don't know if you want me to go through it. I mean, I don't know.
It was a good update, I think. When you asked for how long you've got, you've given the answer there, Miles, and I was going to say 10 to 15, and
Okay.
you've used 10 now.
Okay.
Really helpful.
We did have a question on the CP in 2026. Maybe you just explain what that CP is in the debt maturity profile.
CP is commercial paper, and it's a short-term instrument used to fund QLDC. You've got, what, 80 million or so of it.
What is commercial paper?
So it's a short-term, so QLDC funds itself from all of your funding apart from the HIF funding, the Housing Infrastructure Fund, is through the local government funding agency. Commercial paper is short-term funding, which rolls every 3 months. And it is at just, it's the lowest interest rate. So it attracts a margin of 0.15%. At the moment, it's at 2.5, it'll be about 2.65%. So it gives you by far the cheapest funding. But we don't rely on it all, because that means that you've got too much of a funding risk that's with your funding where it's too short. And we don't want, we want to have a stretched out maturity profile or extended maturity profile. And then you have FRNs, which are floating rate notes, which are, as the name implies, at a floating rate and goes up and down according to the 90-day rate. And then you have fixed rate bonds that at a fixed rate for the life of the bond.
And why do you change it from like 1 year to the next so much, as in 26, 27?
Oh, that's just because we like to extend it. We like to extend the profile out. So you have a mixture of funding from 2026 out to 2031, and we'll look to extend it out further, because you want to have one of the basic fundamentals of funding risk management is you spread your maturity profile, so you don't have a whole lot of funding maturing at once. So that's just a risk management tool that we use to mitigate risk.
So, we're not running that graph that it's the commercial paper expires in 90 days, so they can show it in there as it expiring in that
2026 maturity. Now, on that graph there, you can see the red line up the top. We can't go above that in any 1 year. So you can't have more than that amount maturing in any 1 year. So
Miles, who sells our CP? Is it the panel of banks, and do they put it on their own books, or they put it out in the market?
No, that's the LGFA. You source it from the LGFA.
So the LGFA takes it on, and then it goes out in the LGFA's name.
Yes.
Got it. So there's nothing about QLDC behind it.
No,
Okay.
no, it's QLDC's funding from the LGFA. Yes.
Got it.
Yep.
So the ones who aren't, the ones you're aware of what the LGFA is?
Yes,
Yeah.
now I am.
Yeah.
Maybe just draw
The next
attention
slide,
to,
we'll be even more aware of it.
maybe just draw attention to page 35, which has got the fixed rate energy bands.
Yeah.
So
Oh,
that's
yes.
in our treasury policy, which says that we will have our borrowing in certain percentages in that band, so minimum, maximum, and that's what
That's why it's different.
Miles reporting. He's saying that we're compliant because we have got enough cover in each within those red lines.
Catherine, this is our treasury policy.
You guys
We
do.
do.
Oh, we do?
Yeah,
Okay.
on the LTP, you get to refresh.
Thank you.
Yeah.
Part of this item.
We found the enemy and they are us. Okay.
But we're all compliant at the moment, Miles, nothing for us to make a decision on or work.
Well, you do have to have more funding. So on the next page to that interest rate risk management, the recent transactions and strategy, we took out $90 million of swaps at those 30 million each, going to May 30, November 30, and May 31 at 377, 373, and 377 again. I just actually did the numbers just before, and had we waited till now, that would have made a difference. Well, that would have made a difference of 1.8 million over the life of those swaps. So if I'd taken them out when we did,
So, yeah, this is what I want to ask, was what's the mark to market on the swaps? What you're saying is effectively the mark to market on the swaps is now positive 1.8, is that correct?
the ones that we took out, just those, that's not your whole swap portfolio. That's just those swaps that we took out recently. So that is 1.8 million. Just on those 3 swaps that we took out is about 1.8 million. Well, I mean, if you.
Oh, you mean matured?
No, that we entered into.
Unwound.
We did them about, what, 3 weeks ago? Yeah.
Okay,
So if we took them out today, the effect would be 1.8 million more in cost.
would it be possible to, all right, so we've got a positive mark to market.
On those ones, yes.
Yeah.
I mean, I haven't, we can get a report run by the banks, or we can do it, and we can actually
You have a
get a
swap
mark to
model,
market on your swaps here.
you have a swap model internally.
Yeah.
Okay, it'd be great to see a mark to market and the details.
Okay. Yeah,
The
that's fine.
ISTAs.
Yeah.
Is that all right? Is that
Yeah, no,
okay to
that's
ask?
fine.
Sorry.
No, we've got a pricing model in our Auckland office that they can do that. So
Yeah.
whenever you want it, I mean, we can do it
Right.
monthly or quarterly or in these reports, or
Right.
I won't say daily.
And there's no bells and whistles, they're standard swaps, right?
Yeah, they're just straight vanilla fixed rate paying swaps.
Against BKPM.
Miles can produce any graph you like. He's got an army of graphs behind him, all this information, so
Oh, good.
it's something that you're
Matt,
wanting.
and then we'll come to you.
Swap geeks.
Miles, less of a financial question, but a lot of what we're talking about today is influenced by global political state.
Mm.
How do you take that into account when you're sort of crystal balling some of the things that are happening, and obviously in the financial setting? How are you actually getting information about what the geopolitical state
How are
is?
we getting information?
I know it's a tough question to answer.
No, that's fine. We subscribe to Bloomberg, which is a paying service, which has all financial and economic information. Also Iris, which is another financial market information provider. We subscribe to various publications and we read religiously.
So they are forecasting what potentially leaders are doing or thinking of doing. Or...
I mean, thinking about forecasting what leaders are doing at the moment is quite difficult.
Do you give an A/B split of which direction they go? Potential outcome.
What we say is that, look, we can't totally predict interest rates or currencies, because if I could, I wouldn't be talking to you. But we take into account. I mean, the approach we take is that we manage your risk, so we're risk managers. But that doesn't mean that we take every bit of risk off the table. So we will actually have a view on where interest rates are going as well, and we throw that into the mix. So we have to combine an element of what is the best risk management approach, what is our view on interest rates, what is the market's view on interest rates, and it's one of the charts that Catherine was referring to, or several of the charts, give an indication of where the markets think the OCR will go and it's numerical and as well as graphical, and will show where markets are projecting. And as I said, the Reserve Bank are projecting the OCR to be 3. The markets are projecting it to get to 3 in the next 18 months. So there's a wee bit of a disconnect there.
At Treasury policy, it's there, so there's no major surprises. Yeah, Miles isn't here to speculate on winning the interest rate. The interest rate lottery. He's here to manage that, so that we've got certainty what our interest rate will be, and it'll move with the cycles.
That's a very good point. And that's why we have, good, sorry, I should have said that, the policy, because it does force you to do something. We operate within parameters, and we will adjust the parameters according to where we see interest rates going. So it's in a band, but it does at least force us to do something, and doesn't doesn't allow us to do too much.
Is it,
Listen to the economists, and they're wrong, because they're always wrong.
just on there, is that policy, do you see any gaps in it? Is it fit for purpose for this kind of strange context that we're in, Great. Perfect.
What we say is with a Treasury policy is that it has to be fit for purpose through multiple economic and financial market cycles, political, economic and financial market cycles. You don't change your policy just because a war has broken out. If there's a fundamental change in financial markets, which would take several years to identify, and we have changed it as a result of that previously, then we will do that.
That's kind of what I mean, because you made the point about not really knowing what leaders are doing these days, and it's a kind of slightly different, less predictable context, maybe. I've got one other question, which is, it's about the policy, but it's just about this change with this rates cap, and it's just because of the expertise in the room, I'm just going to tap it. If you've got an opinion, we haven't put our contingent liabilities around our GFA and others on our books, on our ledger, and that my understanding is the advice has always been because we can always raise more rates, so we don't need to worry about it. But now with the debt cap potentially coming in, and it may disappear, but if there is a debt cap, do you think there is some merit in recording our contingent liabilities on our books within our, debt headroom? Do we need to somehow, or for a portion of it, or do we need to add into a policy that we need to account for a certain amount of it on our books? Or
I'm not sure. I can't quite see the correlation between the 2 points, because I think you've raised 2 different points here. The first one is as far as the rates cap goes. Sorry, I wasn't mean to be rude or anything.
No, you're not.
The rates cap, and we have talked about this at work, is it will probably require higher levels of fixed rate cover, because you will have less ability to absorb increases in your interest costs. So we will probably, when these rates caps come in, have to move to higher levels of cover.
Right.
Now, Queenstown had a weighted average cost of funds of 2.05% back after COVID, and then with the significant increase in debt levels, where they just happened to come when interest rates were high, and this was the leaky home settlement and other ones. So
I guess that's really interesting and helpful. I guess my point was around we're guaranteeing the debt of other councils, and it's an interesting time. Some of them are keeping Three Waters in-house and working with a rates cap. I'm just wondering at what point we understand in detail what our liability is in some of those spaces. We are guaranteeing, and we've given guarantees to the Housing Trust and various things, but we don't record them on our books because we've always been able to raise as much rates as revenue as we want, because there hasn't been a cap. So
we do have the guarantee in the annual report.
It's written in there, but it's not on the books. Like, it's noted, but it's not become a functional part of our books.
Probably not a question.
It's possibly not.
No,
I just thought since you're an expert in that we were policy, but feel free not to.
No, I think I'm right in saying that the Auditor General's Office have said that you don't need to, and I might be wrong, I can check it, but somewhere in the deep, dark recesses of my memory, I've got an idea that the Auditor General said that you don't have to have any numerical number associated with the guarantee.
I think you're right.
It's a zero liability.
I'm just wondering if that's changed since the debt cap, or if it should. functionally,
The
practically.
debt cap or the rates cap?
The rates capped, sorry.
No.
It's not legislation, so it may well come through there.
I just be interested in investigating it a little bit, but thank you, that was really interesting as well. With the,
And what was the other question? So it was the rates cap and,
I think.
and the LGFA, and were you concerned about the guarantee?
Well, yeah, that was it, because it's not on our books, but you're saying we don't need to
Oh.
record it as a contingent liability.
No.
It's not
Um,
certain.
Yeah,
Yeah.
it's noted in our annual accounts.
It's
but we-
noted.
We don't quantify it.
We don't
So
quantify it,
probably
and
also-
and that's, I guess, what I'm looking at now is.
That is how you disclose.
Should we be quantifying, should we be?
No.
Look, I can take that offline, thank you. Thanks, Miles.
Do we go through the treasury management policy with you? Is that something you would do?
Yes, we review it every 3 years in conjunction with the LTP.
Has anyone got questions on the policy per se? Also then Charles' report?
They were mine.
On that note, then, item 2, would anybody like to move? Have a second there?
Oh. Sorry, because I had just one more thought. It would be really useful if this committee works through this policy. You know, we've talked about committees working through policies, not just full council, so we can take a bit more time. Do you think we could schedule that in?
It's like a workshop? or-
It's like a workshop working through the treasury policy with Miles ahead of full council doing it. I don't know if that works for the chair and tomorrow. It might not be necessary, it might be too. This is an option, and I'll leave that to Keith to decide on.
I'll take that away. Thank you. Okay, all those in favour?
Aye.
And opposed? Motion is carried. Thanks, Miles.
You want me to stay here?
Oh, yeah, LGFA. Yes, you might as well. So now the new item 3, which is the LGFA Funding Agency Annual Report. So this is the first time this report has been shared with councillors, I understand. Catherine was saying, or Catherine and Patty mentioned that this would be a good committee to bring that to. So yeah, you're going to present that to Patty.
So just those of you who aren't familiar with the LGFA, if you go and, this is a wee bit facetious here, if you go and Google the LGFA when it was first being set up, I Googled it. This was years ago, and I got the Ladies Gaelic Football Association, or the Lake George Fishing Alliance, but no, it's a local government funding agency, in case you're Googling it.
Our GFA is our main financing. So, as Heath mentioned, or the Chair's mentioned, this is a new report, just for noting. So there's 2 reports within it. There's the annual report, at 30th of June 2025, and then there's a December quarter update as well. So take the report as read, and happy to take any questions.
So my takeaway from going through it is that I didn't see any red flags there that we should be concerned about them being a primary lender at this stage. Wasn't much outside. I got out of it, to be honest.
Could I ask a few blue sky questions about the LGFA?
15 at least.
So our longest funding option is 12 years, right?
Yes, yeah, 2037.
Yeah,
11
and
years
that
now.
is mandated by the LGFA,
But they don't raise debt beyond April 2037, no.
right? And so the LGFA goes offshore and borrows longer, is that correct? Or do they not?
No, the LGFA has, they fund themselves 2 ways. One's through regular tenders in New Zealand.
Yeah.
And also they do private placements offshore.
Right, okay, so those private placements, how long do they go?
I'm not sure what the exact term of it is, but I don't think it goes beyond that 2037.
I see, so they match fund.
No, they don't,
So-
they don't, the LGFA don't match fund, no.
Yeah, and it, okay, but
So-
I mean, approximately, they don't go beyond 12 years.
No, what they do, is this might be, no, actually you asked the question, I might be preempting it.
Okay, well, that's all right. So Auckland and Christchurch fund under their own name and not the LGFA, correct?
They fund both under their own name and with the LGFA.
And who do they go domestically or do they go offshore?
So Christchurch goes only domestically.
Yeah.
And Auckland does do a portion of its funding offshore.
And how long do they go for?
Auckland's longest debt, I think, but that was an onshore one, was 2050.
You know, 2050.
Yeah, they did do a 2050
So,
bond.
oh, okay. So,
In New Zealand, but that was in New Zealand dollars.
yeah,
I think they probably go into it's probably more like 5-7 years offshore.
but do you know who they did it with?
Oh, I can't remember it. I mean, they've done quite a number of
With
tranches. I
sovereign
mean,
law funds, whatever?
oh, it would just be to the institutional investors, yes, offshore. I mean,
Okay.
you know, that could be hedge funds, it could be sovereign wealth funds, you know, it could be life insurance companies.
So just for grins, the swap curve is well through the government bond curve, right? I'll get to this. I'm not trying to
Yeah.
do inside baseball stuff. I can explain in a second, right?
Yes,
It's well below it.
it's below the government curve at the moment, and that's just because, I mean, that's sort of a bit of a
Right.
symptom worldwide because of the amount of sovereign debt that's taken on over COVID.
And 30-year swaps aren't quoted in New Zealand dollars. Right?
Very rarely used though, yeah, I mean,
I-
really
I
beyond.
think I did the first one
Yeah,
a long time ago.
yeah.
So here's, effectively, we know what swaps are. Why can't we fund it? If people are doing 30-year swaps, why can't we do 30-year swaps? And they're well through the curve.
Yeah, well, the reason is that they're still very high. Because, I mean, the yield curve goes like that. And, you know, like, you know, the OCR is at 250, the 10-year swap is at about 430. I'm not sure, I haven't even looked at what the
10 years right now at 430, 429.
Yeah,
And 30 years at 490.
yeah. One, your policy doesn't allow it because you can only hedge up to 10 years.
Right.
So that's
The policy that we wrote, yeah.
Yeah, yeah. So you can only fund up to 10 years.
Okay.
Yes. It does, you know, I mean, going out that far does cost, yes.
But why are swaps so expensive?
Why are they so expensive?
Can I just make a real quick 60-second case on the whiteboard? What?
No, not in this meeting.
No?
No, I don't think we need that.
Okay, but the point is this. The point is that because pension funds and insurers have such extended liabilities and they can't catch up to them, they're receiving in swaps, they're buying swaps. So the back end of the curve is negative in most countries, and in ours it's positive.
Yeah.
And so my thought is, and especially given the Auckland example, and you saw per the example from the CFO of the airport, that we could fund under our own name much longer than 12 years offshore in New Zealand dollars.
No,
Legislation says.
you're not allowed to.
Okay, but because of the policy that we wrote.
No. So you can't fund yourself because Auckland is the only council that can fund offshore in foreign currencies, and that's under the local government in brackets Auckland Council Act 2009, Section 107. I preempted this question. So it allows Auckland, and it's titled borrowing in foreign currency. So it allows Auckland to borrow, Auckland Council to borrow in a foreign currency. And Section 113 of the Local Government Act prohibits councils borrowing in a foreign currency.
Except for the exception for Auckland, which maybe we could get an exception.
Well, you'd have to have an act of parliament.
You need a local bill.
All right.
Yeah, and then you have to, I mean, it's, you know, it's a perfectly good question, but then you've got you have to think, well, is it worthwhile, the cost of it? Because the cost of going offshore and establishing, you know, because you have to do a cross-currency swap to bring it back to New Zealand dollars, you also have to have the critical mass, the amounts, because I mean, the offshore investors, I mean, they're not really interested in much less than 300, 400, 500 million. Now, I think that would create too much of a funding risk for you if you had one tranche of 300, 400, 500 million maturing. So it's really the reason why it was done for Auckland was because of the scale.
I think because I've done this.
Yeah.
And sorry, with respect, I'd push back and I'd say that, you know, the New Zealand capital markets are incredibly shallow.
Yeah.
They're no different than 1991 when I got here. We're kind of stuck in the Pleistocene. And we could fund, I believe, much longer dated in Kiwi dollars with offshore counterparties, even in small amounts.
So I think,
And we
as
wouldn't
we're
have
saying,
to do cross
the
currency
conversation is, and it's interesting it is, I understand your time is valuable, Miles. I think this is a conversation we can probably continue outside of this meeting today. But I think, you know, Water CCO, if they want to start looking at some funding options like that, maybe a possibility.
CCOs can borrow in offshore currencies. I mean, like Orion has, you know, Orion, the power company in Christchurch, has borrowed in
Water infrastructure under the CCO model, maybe.
Actually, that might have been
Right.
200, I'm trying to remember how much.
Because they're important, is it? Right? but we've sort of got off topic for what's the scope of today's meeting, but conversation we can keep going or keep talking about Q. So for new agenda item 3, is it? We're going up to 3. I'll move it if you like to note the LGFA report. We have a seconder.
Second.
All those in favour?
Aye.
And opposed? Motion is carried. Thanks, Miles.
Thanks, Miles.
Thank you. You're right.
Looking forward to one workshop.
Conversation.
All right, item 4, procurement, annual procurement plan.
Thank you. Thank you for your nice man.
So 0 no Pam? Pam?
Thank you. Okay, so this is the first cut of the forward-facing annual procurement plan. It's based on information that is actually largely available to the public already. Our starting document is the long-term plan, where I've had questions from people previously, from suppliers, about when procurements might come out. I've referred them to the long-term plan and said, there's 30,000, 30,000, 30,000 over 3 years, and then 3 million. There's a reasonable chance that a procurement's going to happen, but we're trying to make it easier for suppliers to get an idea of what kind of work. So I've also used the Tech 1 contracts register, but that is undergoing some work at the moment to tidy it up. The procurement policy was also considered, and the directorates were asked to feed into this because I didn't have dates. So our first one, it's unfortunate that it's so late in the financial year, but it's taken a while to figure out the best way to do this. And we've just done it in quarters to try and make it easy on staff. So that's what we have initially. We've already started working on the 26-27 plan, and we're taking a different approach to gathering information with that one. And it'll also be broken down into monthly segments, which hopefully will give suppliers a better idea. Not every procurement will necessarily be in there. We do have some panels in place where we have the approval to ring fence to within those panels. And I don't believe that there is any benefit in letting the market know there could be some work come up, actually that they're never going to have the opportunity to look at if it's being ring fenced to a panel. For example, the 3 Waters horizontal works, engineering works. But there's a lot of other work that will be coming out, and including OPEX. So, yeah.
I wonder if in some ways it would be good to have, even if it is going to a panel, or it could be a separate document, just so that when we do go out, you know, they start to understand what, you know, what's the total work within the panel. Also be helpful for councillors, I think, to understand what's going to panels and what's not.
I think we report in retrospect already on contracts. So at the moment, quarterly, we go through GETS and we look at what's been awarded, and that is already reported on our website. So between this and that, it actually gives quite a fulsome picture.
Yeah,
as to
right.
what's gone out.
I'd just be interested as a councillor in still understanding the forward work program for the panels.
Yeah.
But that's a different discussion.
It will be in here when it gets renewed, when the panel gets renewed.
Yeah, when the panel gets renewed. And that's when you see things like the engineering, the water one was $86 million or something, or $81 million. That's when it came through with a picture in the report as to what the work might look like. But I do get your point. And certainly we can have a look at it. Yeah. Yeah. So over the last 18 months that I've been here, now starting to feel like there's a real groundswell of support and engagement in procurement. We've been running quite a lot of training as well, so I know this is a bit off topic, but we did have some feedback from MBIE the other day, who ran another tranche of demystifying procurement workshops for us, that they can see the maturity in the organisation is growing, and that is evidenced by the level of sophistication of the questions that were being asked by council staff. So not the basic ones, but actually really getting into things and getting engaged with the procurement. And I know it's subjective, but I just have this gut feel now that we are actually starting to gain traction, and people are trying really hard to align with the tools that we've put in place.
It's good. All good.
Yeah.
Glad to hear that. The years that we've been there was a few questions prior to this, just for clarity, around the Q1, Q2, Q3 and Q4.
Yep, so Q1 starts July.
Yeah, you comfortable that was answered? So the financial year for council runs from 1 July to 30 June, so Q1 being in July.
So we're now just about in Q4 of this one, yes, this table.
So the next one will be presented in the June meeting.
So we'll have the full 12 months in advance.
Yeah.
I was getting confused by some of the dates here. I was like, 26 or 27?
Yeah, I do too. When that question came through, I had to Google it just to make sure that I didn't have the wrong picture of the world.
And items in here that don't have a dark blue box, there's nothing planned for procurement in those spaces in this 12 months.
The information didn't come through to me in time for the meeting. I didn't want to take it out because then there would have been a question around how much information had been captured. Yeah, but I think now we've got it sorted as to the best way to gather the information.
We'll be watching the Arrowtown pool very close. Cool.
Thank you. I'm curious what the next evolution of this is, and obviously we've got the next 12 months in play. Does it go further to 24 months and further along than that? Is that the intention?
I would like the next one. So once we get the 26, 27 sorted, within 6 months, we'll hopefully have another year out, which will give us 18 months in advance. I'd like to say 2 years, but budgets can change and it's really difficult to plan things that far out for the procurement.
Yeah, I mean, is it a bit like everything when you do it like a long-term plan of let's just say 3 years?
Yeah.
You know, first year's pretty much complete as it's going to fall. Second year, a few changes. Third year, it's sort of a
yes. Yes.
Is that sort of what you would see if you could do a 3 year?
Look, if we could get to 3 years, I would be absolutely rapt. We are having a big rider on this that says this is subject to change due to budgeting, resourcing and unforeseen events.
Yes.
So it would align with the long-term plan, definitely. We could look to do it for a 3 year period. If we can get this 12 months and then build it to 18 and 24, then we'll look at, can we make it 3?
Yes.
What's the reliability of the information? Because it's not just in the long-term plan, it tells us the year we're going to spend the money. But in this, we're trying to tell them the month that we're going to go out to procurement. So maybe the 3rd year would be quarters.
Yeah.
Which gives us some wiggle room.
Of course, you know, examples, COVID and shovel ready funding as well, which brought some projects probably well forward and they probably were sitting in 3 years, maybe.
Yeah.
It comes down to how much work do you do for the benefit you get out of it, I suppose. Like you can make up anything that will change.
Yeah, I think it's just having a little of a long-term view of what's coming up.
Yeah, and it's about transparency and trying to give supplier market as much information as possible, but I don't want to give them information that could be wrong. So I'd rather just do what's accurate. But yeah, we could do it quarterly at that long distance.
Because I imagine a lot of them are planning their work plan for the next 3 years as well, right?
Absolutely.
Infrastructure companies do.
Yeah, and responding to RFXs takes a lot of effort. And while the smaller suppliers are doing that, they're not doing the work that's bringing the money in. So really mindful that if we can help them to plan that sort of work in, then hopefully it will be of benefit.
Well, quick couple of quick ones. Will you check in or will it align with Simon Leary's stuff that he puts out to the market?
Simon Leary has fed into this. So that all of the directorates were asked, and the request is sitting out now for the next year as well. I do actually have live access to one of their spreadsheets. It just doesn't give me as much information as I need.
The other thing was, it would be great when these go out if they could go into councillors' inboxes, just be useful.
There's a note, but it's
perfect. And the other thing is just the descriptions. I mean, I'm sure they'll be updated.
They will.
Light speed. I'm like, oh, what's that? So
I didn't know. Yeah, so I've just taken these from the long-term plan, and one of the things that the CE actually has asked is that we do make the descriptions easier to understand.
Yeah.
So
which one did you give as an example?
Oh, cougar. There's one for cougar, there's one for lightspeed, there's one for quail rise, but it doesn't have anything beside it. So
yeah,
it would help us too, because if these are from the long-term plan, you know, it helps. Maybe it can then go back into the long-term plan and we can improve those spreadsheets and
and
so.
That's all questions. Do we have a mover? Resolution. He's moved, second act. All those in favour?
Aye.
Motion is carried.
Thank you.
Thank you.
Thank you, that was good.
Yes.
Love your work.
Item
What
five.
are you up to?
Is
that four?
Is that financial overview?
New five.
Hello again. So, next report's the financial performance update. So it's based at January year to date. Just got Alison Kelly here and Jeremy Pays and Peter Eady's online. Peter's our interim financial financial controller, sorry. Alison's our manager of our business partnering team. Jeremy's our capital accountant. So we will take the report as read and we're available for any questions.
And yep, and I'm reading my notes and I have completely forgotten where this came from because we've had so much to read, but not completely. So the reserve funds, I'm just thinking, just maybe informing me because there's the opportunity because we're talking about it.
That's that's the investment update.
Oh, yes, that is the investment.
Sorry,
Sorry, I'm going, my numbers are wrong. Okay, yeah, give me a second. Someone else might need to, I'm just going to see where I'm at.
Oh, I've just got one relatively straightforward one. The CIP funding for the shovel-ready projects. Have we got the balance of that through you?
100% received. Yeah, the last 500k was received.
Was. Okay. I think nice and easy. I had another one that actually maybe answered it during the workshop around our net debt to revenue ratios with the CCO.
Yeah. Oh, yeah. Well,
So it's been answered.
Okay, so, when we have the late rate fees, it's quite, is that quite normal, the amount that we get, like 0. How much is it? Huh? Oh, am I in the wrong?
Is that the debtors analysis? Is that?
Yes.
Another agenda item.
Okay,
Sorry.
me and Nikki on the same.
Yeah,
We're
sorry.
gonna hurt ourselves.
Yeah, I mean, I guess anything we need to be worried about going into the last quarter of the year.
No, we're putting a lot of focus on forecasting. So we're keeping a close eye on it. And obviously since January, there's been another month end and things are moving in a positive direction. So there's nothing, no concerns at this point. No.
Probably going to be under the capital spend for the year, I'd say.
Yeah, yeah, in the 90s, obviously, but yes.
It'd be a good one.
Yeah. Well, it's just about Kingston, you know, when you're looking at the Three Waters stuff and you're going, okay, yeah, no, it's fine, we're green. But there's clearly a red project in the middle of that. Look, it probably doesn't matter for the purposes of this report. I don't know, but the fact is, you know, if it's on track, one of them is significantly, you know, out. So therefore it's going to cause problems down the line and create something else is going to be red because that was green. And in other words, the money's been spent, but not on that. That's not on track and the money will have to be spent down the track.
Yeah, and I guess we're coming from that just this financial year.
Yeah, I know.
point of view, and I think that's quite important for the committee tonight, which is how we've got these traffic lights is set up, budget set this, and we're coming in around about this.
At a high level, not within a detailed project.
Yeah, that's right. It's not, not on a,
I just wonder if, I don't know, would it take a lot of work to highlight in red any really gnarly projects within, so we can sort of see, yes, we're on track, but we're not really. Like, we're on track from a numbers point of view, but the fact that one project isn't on track will flow into another quarter's negative reporting. And so it sort of gives a false picture.
For the reforecast.
well, I think it's
We
more
do
about,
see it in other places. I'm just wondering what is the value of knowing that we're green, but
So like when there's a green category, but there's like 5 or 6 different projects in the same box. You mean?
yes, the overall number is within the right, you know, the right percentage has been spent. But in fact, one project is well under, therefore others have gone over, therefore
we looked at the details.
Yeah, I'm looking at it, and it's in there, like it's in there and the numbers are in there, which is great. I just wonder if, because it means we have to read through all of it to understand, and, you know, I just wondered if red highlighter, red text could go over ones that are significantly out.
Yeah.
It doesn't necessarily matter, I'm not.
Is there like a tolerance level if something
I've got
is like a big outlier, do you let us know?
Yeah, we've got, and that's the traffic lights. I think it's yours more about the whole.
It's more about within,
context.
because we have to read, we've got a lot to read and we have to go through all
Oh,
of this
yeah.
to see. So if you look at the green, it looks green, you know?
Yeah.
But actually it's not, because you've got
Yes.
some significant outliers. So some have gone over, some have gone under. The numbers are right, but because some have gone under and
The
some have
majority though are just timing things, which we might be, you know, just either we bring forward or carry forward money at the year end, doesn't mean the overall project is over. Generally, we're not tracking continued projects.
This
if
is
we're
how
out.
much is already, look, correct me if I'm wrong, but this is how much has already been spent against forecast budget. But we know that not enough has been spent on, you know, one or two particular projects, others are over. You're looking at the total for that
I think that's
package.
the- Yeah,
You
the
get
whole.
what I mean, right? So-
Yeah, I think so.
So it's not really green because it will have flow-on effects.
Yeah,
So if, I just wonder if when we go through anything that's actually as an individual project is red, could be sort of just the text that could be read, and then that draws our eye to it. And we
Yeah,
can
we
see
can-
where the exceptions are a bit more
yeah.
easily. I don't know if that's not too much.
It's not,
No, I
it's
think-
fine.
I think it's perhaps an action, Catherine, to take into the ELT and sort of how we frame up the whole CapEx program, like over the, look, we talked about LTP this morning, how that's tracking over the LTP outlook as opposed to this year's just on this financial year. Is that?
Yeah, and it is. But I mean, I guess where I'm coming from is ratepayers pay for certain things to get done, and that's why their rates are as high as they are. If certain, we might be spending the right amount, but that doesn't mean that the things are getting
Yeah.
done that they've paid for. And so we need to be able to see those
multi-year
exceptions, those, yeah, and just, I don't know, just highlight the things that aren't going so well. But we see them in other reports, so, you know, that's why I looked for it.
Yeah, and that's what I was trying to look at, Catherine, what are the
Yeah, so it's not that you don't
So we're
report on
not
things,
duplicating on
it's
that.
just wouldn't necessarily do anything about it in this committee, it just makes the green light. It's not like we're greenwashing thing. Just makes it.
I think the-
Well,
I
we'll
think
take
the
it
point-
away.
I think the
Only
point
if that
is
doesn't create a lot of work.
Yep.
Yeah.
that easier to take away, it's you make us aware of any of those key projects that we are behind and
Yeah,
not meeting or.
Yeah.
But yeah, I'll leave it at that, please. Any other questions for Paddy or the team? Okay, I am happy to move the resolution that we note the contents of this report. Seconder?
Take you back.
Yeah.
I think Nikki's down. All those in favour?
Aye.
Opposed? Motion's carried. Thank you, guys.
Thank you. It's helpful.
Investment update, item 6. Now, section 6. Reserves.
So this is a new report for this committee, so we are happy to take feedback on it. There is a few actions within this one, the recommendations, so, a recommendation for the sale proceeds of 6 Merrinan Street. And then also for, the committee to recommend to the officers to do some, review into some of their reserves and also to, look at a higher accounting treatment for the Lakes Leisure Fund as well. Peter's online as well, happy to take any questions on the report first and then we can go through the recommendations.
Before we get to Arrington, I thought I'd get another stuff.
Yeah.
Is that right? Just a question on the Queenstown Car Park Reserve. Can you just give us a bit of background to that? Where was the car park? That was the first I'm hearing about it, but the background would be great.
Note 2,
Oh,
Yeah, so
no, 2.
it's car parking land reserve sourced from prior land sales, restricted to funding new parking developments for
Yeah.
retiring.
So it's more around the restriction on you've got to spend it on new car parks, is that right? Or updating current car parks?
it's an updating new car parks. I think it's the current car park, so guess these reserves have been there for a long time.
Yeah.
And we just want to highlight them now to start utilising them. The best definitions, or the only definitions that we've got is in that attachment still as well. So
Right,
that's what we're going off, and just the interpretation of what those words are.
I mean, I can take it offline later, but it's just, yes, it's curious.
I can probably add a small bit to that. Look, if you read more into it, I did find it said the primary purpose is to ensure as the district grows, the infrastructure for parking in public spaces keeps pace with the demand without putting a financial burden on sort of the existing ratepayers.
What policies then?
So there would have been a sale back in the day, I'm not sure when, but there's a reserve that was set aside for that.
Okay,
And now we have this opportunity to utilise those reserves.
right. Interesting, thank you.
Question, have we in the past sort of held these reserves as like, used them as debt headroom? Have they been, because we were so up against it?
No, they would have just been sitting on the balance sheet. They wouldn't have been
Held them
included as
aside.
part of the debt. They're not, that equation for the debt doesn't include these balances.
Oh,
Is the
okay.
question you're asking, like, if we want to utilise these funds, but there's no cash available,
Mm.
would we be constrained
Oh,
by?
I see what you're saying.
Well, you
the-
said, yeah, I'm constrained because we're up
Yeah,
against.
it's not sitting in a bank account with its.
No, but it's within our debt limits. So I'm just wondering, I'm just interested because there's quite a significant amount in development contributions and depreciation reserves. And I wonder how we maybe hold them back at times when we're up against our debt limits, or how it might have been in the old days held back a bit. And then I'm interested in the flow on effects for the expenditure and whether we then
We've effectively.
potentially double dipping in terms of needing money for renewals, but achieving it by other means because we need to hold it back. I don't know. It was just a thought because we're in a different situation now, right? So.
Yeah, I mean, all these reserves, if we wanted to utilise them to offset rates, that would be able to be done. If we wanted to then go and spend it on something, we'd have to literally borrow that money.
Yes, exactly.
Because it's not sitting in a bank account waiting.
That's what I mean, but that's what I mean. Are we holding back development contributions, and if we've been holding back
No, that's
depreciation
just a
funding,
slush fund, that's just the.
and that does go in and out as we.
That's
need
why
it.
it takes, sometimes it takes 5 years to get the full development contributions back in. That's just the holding.
Yeah, I'm just wondering if there was some funky stuff that went on in the past, but that's.
No, and there's a lot of these in the annual report are just one lump amount. And this is the first time we've kind of disclosed, I guess, what's inside that lump.
It should be going in and out, the development contributions, right, and the depreciation. Yeah, right.
Especially with our loan balances now.
Yeah. That's what I mean. Yeah. That made me worse. That Lakes Leisure, I'm sorry, I know this has been probably explained before, but the Lakes Leisure Reserve, I don't understand.
No.
So you're going to give us the accounting entries to
Yeah,
get that?
yeah.
Is that?
When you've got results.
Reserve for you?
Yeah.
I wrong.
So that's part of the,
Yeah.
the resolution that needs to be removed.
And is depreciation, is it collected? I should know this, right? This many years, but are we're collecting it by user area and activity. So in all cases, there's nowhere where we're generally doing general rates for depreciation.
No, so, well, ultimately, this is a bit technical. So ultimately, how we track everything. So you know how we talked about activities this morning?
Yeah.
So underpinning those activities is a cost centre. So
Yeah.
we get right down into so everything's allocated to a cost centre. So
Yeah.
when we do depreciation funding, and then it's a mathematical calculation at this stage, we're saying we're going from 30 up to 70% or whatever. And then we'll just track to see, what the depreciation expense is, and then we'll use that multiplier, and then that funding will come into that cost centre there.
So it comes from, so if we use a specific example, water supplies are easy, but let's just say we were doing the rec centre. Do we depreciate the rec centre?
Only not,
I don't
not,
think we do we?
not on the buildings.
No.
We don't know what's gonna be in
Yeah.
50 years' time, but say for Paul's equipment, then we would to replace
Right,
them
so
after 3 years.
that depreciation funding is being taken from a targeted rate from people in the area based on the differentials that apply if there's a differential, or based on the.
Yeah, yeah. Or,
Okay, we're not-
or, so
yeah.
that's
And then it's ring fenced when it comes
full,
in
full, yeah.
and then goes out, back out to that particular activity. There's no mixing of,
No.
In theory. yeah.
in theory.
Yeah.
You get the technicality between the accounting and the cash flow in there. Because yes, that's the bit, that's where there's the disjoint, so we account for the depreciation,
Yeah,
and then when you've actually got to pay for stuff,
yeah,
the cash coming out, the
Yeah.
cash comes in as rates and goes out to buy, replace
Yeah.
stuff. And it's how that's tracked through
Yeah, exactly,
depreciation
yes.
reserves. It's quite-
and that's, I guess, what I'm
it's
making,
quite
what
hard
I'm
to
making
understand.
sure of, is that it's collected from the right people, not the wrong people. And that it is tracked and flows back out to the right activity.
Cost centre.
Yes.
Cost
Cost
centre.
cost centre, and then,
plan, yeah.
and then it depends on the activity as well, how it's funded, right?
Yeah.
So say sports halls and libraries, that's a district-wide rate, whereas the waters that we talked
Yeah.
about this morning is at that scheme level as well. So
Yeah.
that's where you can understand the wide variety of the rating types we have as well.
Thank you.
Information. Yeah, can I just ask, you said you don't depreciate the building of QLDC, QEC? Can you explain why that is and how you manage that?
Yeah, well, we don't know what's going to be there in 30 years' time, and generally with those community facilities, you could get the funding from the Excellence Trust or sort of philanthropic providers, so the third parties.
Yeah, we've never, our depreciation bill's gonna go down an awful lot when three waters disappears.
Yes, well,
Buildings just go up in value.
sometimes,
Yeah, appreciate it.
sometimes they do. Okay. Something I learned after 3 years.
Everybody happy? So I propose the change to the motion now, or we'll discuss that.
Yeah, it depends when you run past the other ones and then two.
Can we split them and do 1, 3 and 4 as one? Does everybody understand point 4 about the accounting treatment for the removal of the Lakes Leisure Reserve Fund? Don't worry, nobody does. So I would like to move the motion for point 1, 3 and 4. Note the contents of this report, recommend the council officers further review applications for use of Queenstown Car Park Reserve, Queenstown Assets Sale Reserve, potentially used to be part of the 2027-2037 long-term plan process, and recommend that council officers review the appropriate accounting treatment for the Lakes Leisure Fund of 3.3 million. Do I have a seconder for that?
Yes.
Thank you. All those in favour? Against? So for point 3, recommend that council officers review further applications for these the Queen's, no, sorry.
Okay,
Point
so
two.
you don't have a motion on the table at this stage, so you technically can move what you like. And it doesn't need to follow the recommendation, but yeah, it just needs to be something that you can make clear so that if the rest of the committee wants to see what you're moving, we can show them.
Okay, I'll just maybe speak to what I'm proposing first, or just the detail of it, so everybody can understand or ask questions. So if you want to go to page 89, so what happened was back in the day, the QLDC bought a parcel of land in Arrowtown on Buckingham Street. There's 3 miners' cottages included in that, 6 Merrion Street, and an old church. Last year, council sold 6 Merrion Street, so it was only a small portion of that total land parcel. When the funds were originally raised, so that bit of land was originally bought in 2007 for $2 million. Into that purchase price of $2 million, there was 4 different sources of funding. It was Arrowtown Assets Sale Reserve, the Arrowtown Endowment Reserve, and the Arrowtown Heritage Fund. And the balance was then funded by a short-term loan by council. That $2 million bought that whole property that had the 3 cottages, 6 Marion Street and the church. 6 Marion Street made up 29% of that purchase price. So whatever 29% of $2 million was, that was the market value of 6 Marion Street at the time. So the total contribution that was made by the Arrowtown Reserves and the council was split between the 5 properties. 29% of that was for the purchase of Marion Street. Coincidentally enough, the funds contributed from the Arrowtown Reserves was 29.25%. If you add together the funds that came from them. There's a number of options that were proposed to us to allocate the sales funds based on CV, based on original purchase price, based on things. I'm proposing that we allocate out the net sales proceeds based on the portion of funding that came from the Arrowtown Reserves originally for the purchase of 6 Marion Street. So what I'm proposing is 20.25% of the sales proceeds is redistributed back to the Arrowtown Endowment Reserve because the other reserves don't exist any longer. And by my calculation, that is a balance of 600,797 rounded to decimal places. And read you all numbers. That's 29.25% of the sale proceeds of $2,054,008.
No, it's a different figure again.
Okay.
So that was the original contributions, but I'm saying it should be the proportion of the sales proceeds made up in the same.
So are you essentially gifting it back, giving it back?
Paying it back.
Paying
Yes.
Paying it back.
So what figure, can I just clarify again, please?
So the 29.25% to the Arrowtown.
Yeah.
Now that'll be 29.
Yeah.
25, so that's 600,797.
Mm,
797.
I'm trying to understand in my own mind. I mean, I get it. I'm trying to understand why 29 works and 21 doesn't.
29 was based on capital value.
Yeah, because the value, the proportion of the sale was, I think, which was Mariner Street, based on the valuation at the time was 29%.
Purchase.
But they contributed 21%.
So the Arrowtown Endowment
They left out
Reserve
the
contributed 21%.
Yes.
The Arrowtown Asset Sales Reserve contributed 5%. And the Arrowtown Heritage Fund contributed 3%.
Okay.
So I'm saying all
I get it.
3 of those reserves should be what makes up.
Sorry, I was just hooked on that 21% and not the other pieces. Okay.
Any other questions or clarification there? Everyone get that?
You got the right wording, Jane, if you're happy with
Well,
On the screen.
yeah.
I think it's
How do you want to change
the recommendation.
the existing recommend?
So it should still be option 5. It's still based on the funding contribution at the time of purchase from more Arrowtown Reserves. I think that's all the same. Which should be 29.25%. Arrowtown Endowment Land Reserve.
Yeah.
So what would be changed?
I think the only thing you need to change is 0.4 to 0.6. And then that's a 1.4.
Yeah.
0.4 change to 0.6.
At the risk of beating a dead horse, what is even the justification for only paying 21% for them?
The other 2 reserves don't exist any longer. It's the answer to that question.
That's not fair.
And then the 1.6 goes to 1.4.
1.6 changes to 1.4.
Okay, so those are 2 changes.
Yep.
So what that effectively is saying, well, in my mind, is that the Arrowtown Reserves were a 29% shareholder in the total land. We've sold 29% of that land. But Arrowtown still was a 29% shareholder in the existing 3 cottages in the church.
Yeah.
If you guys decide you want to sell those.
Yes. And we could recommend the same approach. The rest is sold on track.
They were quite a challenge finding the old minutes and.
So
I was literally emailing Dave Martin, can you tell me what the breakdown of the funding was? And then I
It's
put you in that.
confusing because they were so
Similar.
21 to 5.
Yeah.
Because the 29 was the same as the
Right, okay, follow, feel like you made that really confusing with the numbers. Yeah.
So you're.
So I move that we recommend the council that sales proceeds of 6 Marion Street are going to be allocated to the Arrowtown Down Lane Reserve, 0.6 million lawrence share of the original purchase price to repay GLD and to repay GLD onward. Thank you. Those in favour? Against? Motion's carried. Thanks, guys.
So you voted that's what you're able to come up with.
Yes, they would.
I already emailed Susanna Martin, who's the widow of the vendor that sold it to council, and told her that this was happening. She was very happy.
Lots of mouth.
Like
Yeah.
that,
Yeah.
I'm gonna get now. Oh, sorry, we've sort of moved on past that, but paragraph 20 and 21, what's coming to the next? I just want to make a note that I'm looking forward to seeing that. The investment report for the investment properties, development properties here at Jessie's, and the
next one.
the working capital alignment to the treasury management. Looking forward to seeing that. Next paper, thanks. Catherine. Okay, item 7. Keepers update. The chat for this one.
I don't know, introduce the reform.
So, we've just introduced Victoria Harper. So Victoria is our financial services manager, so looks after AP, AR and rates team. Been with us about 12 or 6 years now and done an amazing job in that space, to be honest. So, this paper is another new one. It is a debtors update for this paper. We've just done a deeper dive into the debtor management process. Thank you for any feedback based on that as well. Just got a slight correction to the paper. I'm sorry to bring it up. It's paragraph 20, and we talk about the internal audit. Okay, and you can see paragraph 21, it says debt reporting is unclear and inconsistent across the systems. That was actually the third finding of the internal audit, so that should technically be, I should have had that as 20.C. So it's okay. So it's 3 findings that come out of that internal audit. Overall, this paper is for noting, but yeah, as I mentioned, happy to receive feedback and we'll hear for any questions as well.
Thank you. So for point 3 there, just trying to get an indication of where we sit with the national average with some of these overdue debts. We're a high growth, got lots of developers, all those sorts of fun things. But do we benchmark ourselves against the national average?
No, not at all. Patty, is there
No,
something in the past?
it's a good question. No, we don't. We haven't really done it in the past, and just thinking through how we do it and who we can compare it to. You know, there's probably some ones out there like Sal and you know, just with the size of councils and the uniqueness that we have with the growth as well. But our benchmarking more or less where we've been in the last 12 months. Still never typical council thing. So,
Comparing ourselves with ourselves.
yeah, where we were. Yeah.
We're improving.
So yeah, no, some food for thought then.
On that point, can I just follow on from that? Just as we used to, at AFRC, we used to have the debt sort of track, we'd see the trend. So you had last year's and even the year before, so that we can see where we're heading. Do you reckon in future reporting we could include that? Basically, it used to be really good, so if you just go back to some of the old AFRC reports.
Yeah, it's definitely something in terms of the evolution of this report I would love to get to.
That would be great.
Just finding the parameters, you know, what we want to actually see and show you.
Okay, I'm just saying, from my perspective, and it may not have been as it should have been, but it was useful the way we used to have it reported at AFRC, however that was.
Is it still in the financial update?
It was, yeah, and the other report as well. So in that paper there, or the PowerPoint presentation with Alison and Jeremy. So
it just tracked the 90 days and whether it was,
Oh yeah.
What was old debt and new debt and
yes,
the difference. Do you remember doing it?
Yeah. So it's in this, Yeah, it's on that previous paper.
It is in there.
That's, sorry, we put you wrong there.
It's just a variance to same time prior year, but it's up or down, but it's not, yeah, I know what
They used to have a little table,
Yeah,
and it was just really easy
90
to,
days, right.
yeah, we had it broken down. and then
Yeah,
say
variance
some-
prior year.
yeah, this makes it more meaningful
Yeah,
than,
Number.
Yeah, that's in that previous one, so,
okay.
but give us an update if there's anything you want enhanced from that.
Yeah,
Can I lead on from
yeah,
that
sorry,
one? Which was anecdotally then, do we know whether we're trending up or down in terms of our debt?
Most definitely down.
It's
It's absolutely been a focus. So over the last, I'm going to say 2 years, we've had a data management framework, which we've been working across the organisation in different areas. So I started in the rates team that had huge debt, and weaving into their processes every week, every day almost, are debt processes. Not just looking at straight collections, but why aren't people paying? Did they receive their invoices? Have we got enough ways to pay? All of those different pieces to the puzzle. So in rates, as an example, as we have found those problem areas and resolved them, it has helped debt go down and down. So we're working in the P&D space presently, so in consent debt, and also they're looking at the application forms and who signs it and how do we communicate with our customers. All of those things that ultimately, if you don't do it right, leads to debt.
right.
So yeah, definitely on the improve. We've also got increased engagement across the organisation to have those debt conversations, and also being consistent. We've got a credit controller now. So for the last 12 months, it's her sole focus to work with other teams, find those problem areas, fix them, and work with our customer base. So if a customer or rate payer comes to us, we'll bend over backwards to do a payment plan that suits them. Give them time, give them different terms, different ways to pay so we can work with them. Our problem area are the people that don't engage with us. And you know, sometimes it gets to Bay Court, sometimes it gets to legal scenarios.
Sorry, to lead on from that then is third-party debt collectors, how big a issue is that in terms of how often do we use them and what sort of volumes are we talking?
So it's definitely growing. We've had a period of time, I'm talking a handful of years ago, where it was just sporadic. Occasionally something would get referred to, say, Bay Court. Over the last 12 months, we've had the credit controller in play. She's been working with the different debtors. When she gets to that point that she's exhausted all options, it'll get referred to Bay Court. At the moment, I think we've got 34 debts sitting with Bay Court. We don't use Bay Court for rates at this point because the team is so engaged with working with rate payers.
All right. And is it fee paid out of the rates that you're receiving or trying to recoup, or is it?
It depends on the particular debt. So if you would imagine an application form that has terms and conditions on it, if the terms and conditions say collection costs will be added,
Sure.
the debt will be dealt with that way, and the 20% or whatever the fee is for that type of debt.
The user pays.
Yeah, absolutely.
Thank you.
And another follow-on, I guess, is what categories, because we used to get that reported as well, it used to sort of show where the problem areas were, so where was the greatest percentage? Do you know where that's sitting? Is it with residential or commercial or
you mean with
rural
rates?
customers? Yeah.
Residential still and vacant. Use historically used to be around 60% That's come down a little bit into still in the 50s.
Okay.
Yeah, but you're starting to see more of a commercial and accommodation.
Okay.
Which is the larger dollar value as well, right?
Yeah, it's relevant to looking forward to our rates percentage increases and sort of what people can afford and what the outcomes are. You know, are people moving out of the district?
Yeah.
I don't know.
Absolutely.
I see, and probably more anecdotally as well, is there genuine hardship in that space at times?
Yeah, it's always the odd individual that has a set of circumstances for hardship.
So that's a group, a growing group?
No, anecdotally, no. I think we are offering more options to people. So in the last 12 months, we've started in the rate space weekly and fortnightly direct debits. Obviously, it's a lot easier to budget for a weekly payment than a monthly or quarterly payment. So it's those sorts of things that have helped people. Yeah, if we've got someone with genuine hardship, we will work really hard to understand their situation and put something in place for them.
And so it's generally our first principle was to work out a repayment terms and go through that. And then as Victoria's mentioned, we've got different sort of mechanisms as well, the direct debits, for example. Just linking back to the LTP discussion this morning and on the finance policies, we mentioned the rates remission and postponement policy. So it's really prescriptive, right? So if you go right down to that level, it's really watertight on what we can apply hardship to. You know, one other vehicle avenue that there is there's a DIA rebate. Okay, so we'll really, and Victoria's got a member in the team who's really proactive with how we manage that as well.
That's for low income earners, which the criteria extended in this financial year for gold card holders as well. And I don't have the numbers on me at the moment, but there's at least a 50% increase in the number of rebates that we've helped process as a result of that wider criteria.
Could we get some reporting on what that's costing ratepayers? The remissions policy and postponement policy, it would be really useful to see as much detail as you feel is appropriate, but those numbers would be useful because we'll be setting.
Lost to us, or is that a reimbursement from the DIA?
Oh, so the DIA, the rebates, we are just a processing service. So whatever we approve for our ratepayers, DIA reimburse us for.
So that's not lost.
So no, not at all. We're just the administration of that. But for the other remission policy, yeah, we can absolutely provide those numbers to you. Every year, the remissions are set at the start of the year, in July, when we set the rates. From memory, it's something like $140,000 over the $200 million worth of rates. So it is very small, and most of that is in the sports and community groups who get a remission. But yeah, I think there's one heritage property that gets it.
Okay. And the criteria for that are all in our policy?
Yeah, so the criteria for that is in the long-term plan. It's looked at every long-term plan, and we will workshop that in the coming weeks.
So the Rating Act has a schedule at the back of the Rating Act, which has people who are exempt from being rated.
Yeah, 100% and 50% rateable properties, so Schedule 1.
That'd be great. Just when it gets workshopped, if the numbers could come back, then we can see what we're dealing with.
Absolutely. Obviously, if we provide a remission, it means that those funds are spread across the rest of the ratepayer base. So,
Thank you.
And last one.
Sorry, last one. One last one for me. I actually want to change topics to vehicle infringements. And it's 2.9 million is outstanding in debt. Just wondering, what does that relate to in terms of percentage of the total amount of infringements? Do we track that? Do we know? Are we talking? Are we losing a lot, or are we recouping most?
Peter, maybe.
We do lose a bit.
Look, obviously the 2.9 million, some of that debt actually goes back 15, 20 years. Because obviously, look, after 56 days, look, QLDC pretty much lose control of that debt because obviously it goes to the Ministry of Justice, right? So we can't actually write it off. But look, if I looked in the first 6 months of this year, we've collected about 2.5 million in infringements for vehicles and about just under 400,000 for freedom camping. So yeah, we sort of get roughly about $500,000 a year out of vehicle infringements.
So has that increased since the bylaw came in? Just so that obviously this summer's been a bit different with the bylaw.
The freedom camping. Look, the freedom camping has increased since last year. Yeah, obviously, last year I think we had less than 100K. I don't think it's back to pre last year yet. But yeah, it's on the way up.
Yeah.
Look, I couldn't tell you the split out of that 2.9 million. I couldn't tell you the split of how much is freedom camping at the moment and how much is vehicle. But look, I am trying to get that information.
And for those infringements that sit with the courts where they will then potentially decide on a long-term payback, that has to stay obviously on our debt.
Yeah.
Yeah, and they pay us monthly, whatever they have.
Yeah.
We do
It's
provide
a month.
for it as a doubtful debt.
Yeah.
Yeah.
An aging process where 6 months will start to say, oh, we're not going to get X amount up to 2 years before they write off. You just refer into your notes there. So page 73 sort of has a high level overview of our debtors. So total outstanding is 32 million. So roughly 2.9 is around 2%.
Thank you.
I think it's approximately about $30 to actually lodge with the court. So that actually gets added on top of the infringement as well.
So I guess what I'm hearing is, I mean, there's some big numbers in there, I guess, in the grand scheme of things, relative to like their total revenue. Doesn't look too crazy to me, but the takeaway I'm getting is that it's actively being worked on.
Absolutely, yes.
Good work. Okay.
So on that note, does anybody want to move a motion to note the contents of this? Second. All those in favour?
No, discussion. Look, it's just around the audit finding that I think our audit processes are great. I'm really keen, happy with what's coming out. I'm just wondering where the workings from that, where it's being reported to. That was the only question. Sorry, I'm just that.
It will come to the risk and assurance.
It will come to risk and assurance. Okay, great, thank you.
I'll just I really like these reports, and we're starting to close the gap on some of it, which is great.
Yeah.
Our understanding of how to work. So, well done.
And on that note, are we getting a doubtful debts report for the next thing? Is that right?
And then we can show you what's in there.
Was that part of the discussion that you're going to bring something like that?
Oh, it's the public excluded.
Oh,
right,
sorry.
debts that is written off.
Right.
Yeah, we thought we might share that.
Okay, all those in favour? Opposed? The motion is carried all. Declare the meeting closed at 3:26. See, that's really fresh as well now.
So, well,